Hello, and welcome to the June 2024 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora. Joined with me is Mark Zavitz. Today, we will be going over model portfolio performance and then talking about some changes Mark and I plan to roll out to your portfolio to reduce your fees over the next few months. So let's get started. Here's your performance. All of our models month over month are up about 1%. And on a year-to-date basis, performance is quite strong. The very conservative model, as you can see on the screen, is up about 3.82%. The conservative model is up about 5.23%. The moderate model is up about 6.86%. And the growth model is up about 8.34% after all fees. Things are looking quite good. Mark, you've always got a great take on this. What would you say is driving markets and has been some of the catalysts behind some of this great performance?
All right. Well, yeah, Greg, the performance is excellent. Just the 1 year for the very conservative portfolio is around 9, and the growth model is around 16. Everything for the last year, interest rates have finally flatlined and have started to roll back a little bit in the last I would say in the last 3 months. So the fixed income is just starting to add some value into all portfolios, not only ours. And interest rates look like they have definitely peaked because inflation has started to move back to the 2% global target. Depending on the country, in the G20, most countries are looking at 2.5 to 3% inflation versus a year and a half, 2 years ago when it was very close to 10. In the G20. So we've also got some decent earnings, and we've really got significant leadership coming from the tech stocks. The models that you put together, Greg, have a 25, 30, 35%, 40% weighting in large cap US companies, and there's a significant amount of technology in those portfolios, and the tech sector is really showing a whole bunch of leadership, particularly the artificial intelligence companies. So it's excellent. And I guess the last thing I would like to say is that the other reason the performance is excellent is because your models, the models that you put together a couple years ago, are have a very large component in exchange traded funds, and those funds are passive and they're lower cost, and you add in the reduced cost with the passive strategies that get a significant amount of exposure into the large cap US tech stuff.
Yep.
And the returns are fantastic.
It was, the timing of, the fees by themselves are going to add substantial performance by reducing the fees, right? Because the hurdle's lower for all clients. But just the passive ETFs and how they work and how they allocate their stock exposure. Well, it's based off of weightings, and the best performing asset class right now is, it's Japanese stocks, but the second one is US stocks, US large cap stocks, and that makes up about 40% of everybody's stock allocation in their various models. So very thankful that we have this allocation. Not to say that we're going to keep it in the future. In fact, that's probably going to be something that we change because it's been a good run. But that's been the leading driver of why we have such great returns.
Yeah, and Greg, I know we've mentioned this in many previous podcasts, but those passive exchange traded funds, ETFs, they outperform the managed products 90% of the time.
90% of the time. And the other caveat too is we don't know how to pick and choose the 10% consistently. Mind you, we still have some of those pieces in the portfolio, and that is something we will be looking to change because the evidence just continues to support strategies that are passive in nature, or like passive strategies that are low fee because they just deliver better returns. So here's a breakdown of what you pay, our average client pays. At the top, you'll see an average client fee, and it's broken down by household of invested asset size. So this average fee combines everything from the service fee you pay Mark and I down to the product fee. So it's a combined fee. Research suggests that one of the biggest contributors to your portfolio performance is the fee that you pay. And so Mark and I are constantly looking at ways to deliver you better returns by reducing your fees. Well, as most of you know, and as what Mark just alluded to, we added ETFs to your portfolio and it resulted in better returns. And what we want to do next is bring your total fee down even further to get you even better returns. And this is something that we hope to roll out to you in the next 6 to 12 months by using better, even more efficient product. On average, we want to bring down every client's fee an additional 25 basis points. So if you look at the bottom, where it says invested assets, new client total fee, this is where we aim to get you, depending on your total amount of invested assets in the next year. And so why are we showing this to you in a presentation? Well, I really just want to showcase how competitive this makes us. This makes us one of the lowest fee, if not the lowest fee financial planners in the region, or even Canada, I'd say. And given our service offering, hopefully it provides, or we provide you with the highest value, and hopefully you feel that way. I know how other advisors in the region run their practices and what they charge. Since for about a decade, they were my clients when I was a VP of distribution at Mackenzie Investments and at Fidelity Investments. Mark and I have a very high probability chance of delivering what I consider to be strong risk-adjusted returns, or even better returns than other advisors in the area, simply because our fee hurdle is substantially lower. And being a fee-based practice, in addition to having a lower fee, our fee is actually also tax deductible in your non-registered accounts if you have a non-registered account or a corporate investment account. So when you compare it to other independent advisors, such as other advisors at Investia or IPC or Manulife or Sun Life, we come in at like half of what they charge, and the total fee comes in at half. When compared to what you pay at a bank branch, we're going to be substantially less expensive. And when compared to what you would pay, say, at a private wealth arm of a bank, such as RBC Dominion Securities, CIBC Wood Gundy, et cetera, we're on average about a quarter point, so 0.25% to around 0.5% less expensive, which just translates to better results, better outcomes, better performance for our clients. And so that's it. That's what we wanted to showcase. Give you the heads up that we are going to be making some changes to our models to lower fees. It's not going to change risk at all in your portfolio. Actually, in some cases, it's going to get you better returns with lower risk. And we hope to roll this out to you in the coming months. Thank you so much for tuning in and listening to our June update. We look forward to delivering our next monthly update to you next month. Have a good summer month of June and July. Cheers.
Have a good summer, everyone.